Meet Alex and Ryan. They're both 25. They both have $10,000, and they both invest another $500 every month. They both want the same thing, financial freedom. But they make one very different decision. Alex buys an index fund. Ryan starts picking individual stocks. At first, Ryan looks like the genius. By the time they're 30, he's ahead. By 35, he's even further ahead. Then, the market crashes. Ryan watches half of his portfolio disappear. Alex loses money too, but he does something Ryan struggles to do. He stays invested. And 30 years later, the question isn't simply who picked better stocks. It's something much more uncomfortable. Was Ryan actually better at investing? Or was he just better at getting lucky?
Because when you're investing for decades, one great decision can make you rich, but one terrible decision can wipe out years of compounding. And the difference between those two outcomes can be surprisingly small. Let's go back to the beginning. Alex is 25. He has $10,000 sitting in his bank account. He knows he should invest it, but he doesn't want to spend his life analyzing companies, so he chooses a broad market index fund. His thinking is simple. He doesn't know which company will dominate the next 30 years. Maybe today's biggest companies will stay on top. Maybe they won't. Maybe artificial intelligence changes everything. Maybe an entirely new technology comes along that nobody sees coming. Alex doesn't know. And that's exactly why he diversifies. He wants to own the companies that win, without having to predict which companies those will be.
Then there's Ryan. Ryan looks at Alex's strategy and laughs. Not because he thinks index funds are stupid, but because Ryan believes he can do better. He starts researching companies. He reads financial statements. He listens to earnings calls. He follows new technologies. And eventually, he finds a company he believes the market is underestimating. Ryan invests $10,000. And for a while, he looks brilliant. The stock rises 40%, then 70%, then it nearly doubles. Ryan checks his portfolio. Alex's index fund is doing fine. Ryan is doing much better. And this is where the story gets dangerous, because success creates confidence. Sometimes too much confidence. Ryan starts thinking, maybe I actually have an edge. So instead of putting his next $500 into a diversified fund, he starts putting more money into his favorite companies. And for several years, it works. At 30, Ryan is ahead of Alex. At 32, he's even further ahead. By 35, the gap looks enormous. Ryan has beaten the index. Alex's strategy suddenly looks boring. And this is exactly how investing mistakes often begin. Not with failure, with success. Because when your strategy works, you don't immediately question it. You trust it even more. Ryan doesn't think he's lucky. He thinks he's good. And then the market changes. Before we go any further, hi, I'm Jax, and in this video, I'm going to show you what can actually happen when two investors take completely different paths, index funds versus individual stocks, and why the answer isn't nearly as simple as stocks make more money. Now, let's get back to Alex and Ryan. It's year 11. A major market downturn hits. Stocks start falling. At first, Ryan isn't worried. He's seen market crashes before. Then his biggest position falls 20%, then 35%, then 50%. Another stock drops 60%. A third company misses earnings expectations. Suddenly, Ryan has a problem. He isn't just watching the market fall. He's watching individual companies fall. And now he has to answer a difficult question. Is this just a temporary drop, or did I pick the wrong company? Alex's portfolio is falling too, but Alex owns a broad basket of companies. Some are falling hard, some are holding up, some will eventually fail, and some will become the companies that drive the next market cycle. Alex doesn't know which ones. He doesn't need to. He keeps investing. And this is the part of index investing that can look almost ridiculous from the outside. The market is falling. Financial headlines are terrifying. People are saying this time is different. And Alex is still buying. Not because he's fearless, because his strategy doesn't require him to know what happens next. Ryan doesn't have that luxury. Every stock he owns comes with a question. Do I still believe in this company? Sometimes the answer is yes. Sometimes it's no. And sometimes he simply doesn't know. That's the psychological tax of stock picking. You have more control, but you also have more decisions. And every decision is another opportunity to make an expensive mistake. Now here's where something interesting happens. The crash eventually ends. The market starts recovering. Some of Ryan's stocks recover. One of them actually becomes a huge winner. Ryan holds onto it, and suddenly, he's back. In fact, over the next few years, Ryan's portfolio starts outperforming Alex's again. So does that prove Ryan was right? Not necessarily. And this is where the difference between skill and luck becomes incredibly difficult to measure. If you flip a coin 10 times and get 8 heads, did you suddenly become better at flipping coins? No, you just got a favorable outcome. Investing is obviously much more complicated than a coin toss, but the principle is similar. One successful period doesn't prove that your strategy is superior. You need evidence over a much longer period.
5 years tells you something. 10 years tells you more. But when you're trying to determine whether someone genuinely has an investment edge, decades become much more revealing. Because the market will eventually put you through different environments. Bull markets, bear markets, recessions, booms, bubbles, crashes, technological revolutions, and companies that completely disappear. A strategy that works in one environment can fail badly in another. That's why the real test isn't, did Ryan beat the index? It's, could Ryan keep beating the index without taking more risk than he realized? And that's a much harder question. Now, let's talk about the math. Alex and Ryan both start with $10,000. They both invest $500 every month. Over 30 years, that's $190,000 of their own money. Now, imagine Alex earns an average annual return of 8%. Over that period, his portfolio could grow to roughly $800,000. Now, imagine Ryan earns 11%. His portfolio could grow to more than $1.3 million. That's a difference of hundreds of thousands of dollars. And suddenly, individual stocks don't look so crazy. If Ryan can actually generate that extra return consistently, the reward is enormous. But here's the catch. Ryan doesn't earn 11% just because he owns individual stocks. He earns 11% only if his decisions actually produce that return. And that's the distinction people often miss. Higher potential returns are not the same thing as higher expected returns for you personally. A stock can go up 500%. That doesn't mean you'll earn 500%. You might buy too late, you might sell too early, you might panic during a crash. Or you might pick 5 stocks that all look promising and none of them become the next giant. Meanwhile, Alex owns the market. And here's something almost counterintuitive about that. An index fund doesn't need to know today's winners. It automatically owns tomorrow's winners if they become large enough within the index. Think about how different the economy can look over 30 years. Today's dominant companies may not remain dominant. New companies appear, old companies shrink, new industries emerge. Some technologies become obsolete. The market is constantly changing, and an index investor doesn't have to manually predict every transition. That's the genius of the system. It lets the market change around you. You don't have to keep guessing which direction it's going. But there's another side. Alex's strategy has a weakness too. He can't escape market-wide risk. If the entire market falls, Alex falls with it.
Diversification doesn't protect you from every crash. It means one company is less likely to destroy your portfolio, and that distinction matters. Because sometimes investors hear index fund and think, safe. That's not quite right. An index fund can lose a lot of money. It can stay down for years. There are no guaranteed returns. The advantage is different. It's about reducing the number of things you have to get right. Ryan has to identify great companies. He has to value them correctly. He has to buy at reasonable prices. He has to diversify enough. He has to recognize when his investment thesis is broken. And he has to control his emotions. Alex has fewer decisions.
Now, fast forward. Alex and Ryan are 45. 20 years have passed. Ryan still owns individual stocks. Some were incredible. Some were terrible. One company he loved eventually collapsed. Another became a massive winner. Alex's portfolio never produced a legendary story. No one asked him at dinner, "How did you find that stock?" Because there was no stock to brag about. He simply kept investing, year after year, month after month. And that's the strange thing about building wealth. The strategy that produces the least exciting story can sometimes produce the most reliable outcome. But we're still not done, because Ryan could still win if he has genuine skill, if he manages risk,
If he can identify exceptional companies, and most importantly, if he can do it consistently. That's the key. Consistency. Not one lucky stock, not one incredible year, not one bull market. Decades. And this is where the psychology of investing becomes more important than the spreadsheet. Imagine Ryan's portfolio is beating the market by 5%. It feels amazing. Then, another crash hits. His portfolio falls 45%. Alex falls 30%. Ryan now has a choice. Does he trust his strategy, or does he abandon it? Because a strategy that looks brilliant when you're winning can feel completely different when you're losing. And that's why the best strategy on paper isn't always the best strategy for a human being. If you can't stick with it, the theoretical return doesn't matter.
Maybe that's Alex's real advantage. Not that he's smarter, not that index funds are guaranteed to outperform every stock picker, but Alex has created a system that requires less prediction. And less prediction can mean fewer emotional decisions. Now, imagine you're 25. You have $10,000. You have 30 years ahead of you. You could spend those 30 years trying to identify the next great company. Or you could spend those 30 years owning a diversified piece of the companies that collectively build the economy. One approach says, I think I can find the winners. The other says, I don't know who the winners will be, so I'll own them all. And neither philosophy is stupid, but they demand completely different things from you. Individual stock investing demands conviction. Index investing demands patience. Individual stocks give you the possibility of extraordinary outperformance. Index funds give you diversification and simplicity. Individual stocks give you more control. Index funds give you fewer decisions. And there's one final piece of math that makes all of this matter. Suppose two investors differ by only 2 or 3% in average annual returns. That doesn't sound dramatic. In 1 year, it barely feels important. But compound that difference for 30 years, and suddenly you're talking about hundreds of thousands of dollars. That's the strange power of compounding. Small differences don't stay small. They multiply. Which means the question isn't simply, can I beat the index? The real question is, can I beat the index consistently enough for long enough after mistakes, fees, taxes, bad decisions, and market crashes? That's a much harder challenge. And maybe that's why the most successful long-term investor isn't necessarily the person who predicts the future best. Maybe it's the person who builds a strategy that doesn't require perfect predictions. So, who wins? Alex or Ryan? The honest answer is, We don't know. And that's exactly the point. If Ryan has genuine skill and can consistently outperform the market, Ryan could become dramatically wealthier. But if Ryan is simply getting lucky, eventually the market may expose that. Alex doesn't need to figure out which one is true. He simply owns the market and lets time do the work.
And maybe that's the most uncomfortable lesson here. You don't need to be smarter than the market to build wealth. But if you choose to pick individual stocks, you're making a much bigger claim. You're saying, I believe I can consistently make better decisions than the market. That's not impossible, but it is a very high bar. So now I want to know what you would do. Imagine you're 25 years old. You have $10,000. You can only choose one. Index funds or individual stocks? And don't just comment the answer. Tell me why. Would you rather own the entire market and let the winners come to you? Or would you rather try to find the winners yourself? And if you could choose the topic for my next finance video, what would you want me to break down? Comment it below. I might use one of your ideas in the next video. If you want more finance knowledge explained simply, realistically, and without the usual hype, subscribe and follow. Because sometimes the biggest financial decisions aren't the ones that look exciting. They're the ones you can stick with for 30 years. I'll see you in the next video.